The stock market loves certainty, or at least it thinks it does. When Donald Trump returned to the White House in 2025, a wave of optimism swept through Wall Street. Investors, it seemed, were betting on a repeat of his first term, when the market surged to record highs. The Dow Jones, the S&P 500, and the Nasdaq all posted impressive gains, fueled by a combination of tax cuts, deregulation, and economic growth. Since the beginning of 2025, the market has continued its upward trajectory. The reasons for this continued optimism are numerous. Some point to the resilience of the U.S. economy, which has weathered a series of global challenges. Others cite the transformative power of artificial intelligence, which is expected to revolutionize countless industries. Still others highlight the impact of stock splits, corporate earnings, and buybacks, all of which have contributed to the current bull market. However, amidst this euphoria, a note of caution is warranted. Market history is replete with examples of booms followed by busts. The same forces that drive markets to dizzying heights can also lead to precipitous falls. As we navigate this uncertain terrain, it's crucial to separate hype from reality and make investment decisions based on sound principles rather than fleeting emotions. To understand the potential risks and rewards of the current market environment, it's helpful to look back at Trump's first term. From 2017 to 2021, the stock market enjoyed a remarkable run. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all soared to unprecedented levels driven by a combination of factors including tax cuts, deregulation, and strong corporate earnings. Investors who rode this wave of optimism were handsomely rewarded. However, even during this period of exuberance, warning signs were flashing. One such indicator was the Shiller price-to-earnings ratio, also known as the cyclically adjusted price-to-earnings ratio, or CAPE ratio. Developed by Nobel laureate economist Robert Shiller, this metric measures the market's valuation relative to corporate earnings over a 10-year period, adjusted for inflation. The CAPE ratio is designed to smooth out short-term fluctuations in earnings and provide a more accurate picture of long-term market valuations. Historically, the CAPE ratio has been a reliable indicator of market sentiment and future returns. When the ratio is high, it suggests that investors are willing to pay a premium for stocks, often driven by excessive optimism or speculative fervor. Conversely, a low CAPE ratio indicates that stocks are relatively cheap, potentially signaling an opportunity for long-term investors. As of early 2025, the Shiller P/E ratio is hovering above 37, significantly higher than its historical average of around 17. This elevated level has sparked concerns among some market observers, who believe it could be a harbinger of a significant correction or even a crash. They argue that the market is overvalued and that current prices are unsustainable in the long run. Historically, there have been only a handful of times when the CAPE ratio has surpassed the 30 mark. Each of these instances was followed by a significant market downturn. For example, in the late 1920s, the CAPE ratio soared to unprecedented levels, peaking at over 32 just before the stock market crash of 1929, which ushered in the Great Depression. Similarly, in the late 1990s, the CAPE ratio climbed above 44 during the dot-com bubble, only to plummet when the bubble burst in the early 2000s. However, it's important to note that the CAPE ratio is not a perfect predictor of market timing. While it can provide valuable insights into market valuations, it cannot tell us precisely when a correction will occur or how severe it will be. In the past, corrections have varied widely in their duration and magnitude. Some have been relatively short and shallow, while others have been prolonged and painful. So, what does all of this mean for investors today? Should we be panicking and selling all of our stocks in anticipation of a 40% crash? Or should we be piling in, hoping to ride the current wave of optimism to even greater heights? The answer, as is often the case in investing, is nuanced. While the elevated Shiller P/E ratio does raise concerns about market valuations, it's essential to maintain a balanced perspective. Market timing is notoriously difficult, and trying to predict the next crash is a fool's errand. Moreover, it's worth remembering that the stock market has always recovered from previous downturns, often emerging stronger than before. Instead of focusing on short-term fluctuations, long-term investors would be wise to focus on the fundamentals. This means investing in companies with strong balance sheets, solid earnings growth, and competent management teams. It also means diversifying across different asset classes and sectors to mitigate risk. While the possibility of a market correction or crash can't be ruled out, it shouldn't paralyze us into inaction. By staying informed, maintaining a long-term perspective, and adhering to sound investment principles, we can navigate the inevitable ups and downs of the market and achieve our financial goals. Like and subscribe for more from Top TV today.